Hello everybody and welcome to the market now as of about 10:45 a.m. Eastern on Friday, September the 2nd. First, before we get started, I'd like to wish you a very safe and enjoyable Labor Day weekend. The market shot higher this morning after the Labor Department reported that U.S. employment growth slowed more than expected in August. This is a case where bad news is good news for the market. This could effectively rule out an interest rate increase from the Federal Reserve this month. Non-farm payrolls rose by 151,000 jobs last month after an upwardly revised 275,000 increase in July, with hiring in manufacturing and construction sectors declining. The unemployment rate was unchanged at 4.9% as more people entered the labor market. Following the report, financial markets were pricing in a 27% chance of a rate hike this month and a 57.7% probability when the Fed meets again in December. Okay, on the heels of that news, let's go in and look at three charts that could give us some insight into the week to come. First of all, we're going to look at our daily chart of the S&P 500 spider, symbol SPY. We'll probably go to a longer term chart next week, but there was something I wanted to point out to you on this chart, so we'll leave it as a daily chart. Okay, so when I captured this chart of the SPY, and as you all know, this is the tracking stock that closely follows our S&P 500 benchmark index. When I captured the chart this morning of the SPY, it was trading at $218.37, just atop its simple 20-day moving average, which of course is bullish, that it is still atop that line. When we look down here, we see the 50-day moving average rising underneath price at just a little over $215, and we see our 200-day moving average lumbering along as it would just over the 205 line. Now, we know here still that the August 23rd all-time closing high, back here, the all-time closing high for the SPY was $219.09, which is about $21.90 on the S&P 500 itself. So we're going to call $219 resistance here, or $21.90, as I said, on the S&P 500 itself. We have logical support coming in here right at about $217. And then again, more support, potential support at about $215. Again, the 50-day moving average is right just above that level, that price level. Then we have more support here at the June pivot high, which was at $210 or $2,100 on the S&P 500 itself. Okay, so what we're looking at here, we do have a slight gap, a dollar gap, and that's what I wanted you all to see. If you can see on this chart, yesterday's close, where do I have that? Yesterday's close was $217.39. Then the market gapped up this morning. The SPY opened exactly a dollar higher at $218.39. So we have a 1-point gap here. Many times, especially on indexes, gaps will get filled. So it just could be that for whatever reason, the SPY in the coming week does slip back down to this $217 and 39 cents level, just to fill that gap, that price gap. A price gap is an area where there's no trading. A price gap is an area where no trading takes place. It can take place, of course, in an ETF of an index or in a stock. And a price gap like that tends to get filled faster in index trading vehicles than it does in a stock, by virtue of the fact that there are so many more components. Obviously, a stock is an individual component, and in an index there are quite a few components. So in the case of the SPY, there's 500. So many times these gaps will get filled. It's not a big deal here, but I wanted you to know that if SPY could go back down and fill that gap before potentially going higher. Now, going into next week, of course, eyes are going to turn to the FOMC rate decision on September 21st. Even though today it looks like odds are the Fed won't rise, still we'll be looking at the chances of them raising interest rates on September 21st. And we're now moving into the thick of election season. We'll see if that gives the market a little more anxiety. I can't imagine it giving it peace, but you never know. You never know. So if the SPY gets good enough news, it could move up, continue this uptrend, move up over $219. If it feels like it needs more profit taking to come in, then perhaps it moves down to $215 and even a little bit below. We don't like to see indexes or stocks trade below their 50-day moving average. That's kind of a line there that's important, but we'll have to stay tuned here and see what happens next week. Our next chart is a chart of the PowerShares QQQ. As you all know, this ETF follows the NASDAQ 100 index. That's been very important. Of course, tech stocks are a very large component, or a very large segment of our S&P 500, very large part of our market, very big sector. So we've been keeping an eye. The Qs have definitely been one of the market leaders, with strong stocks like Amazon, Facebook, Microsoft, and so forth leading the charge here. Now, I want to keep an eye on the Qs into the coming week to see if these big tech stocks, these big momentum stocks, can follow through with the upward move that they've had since our June low when we had the Brexit problem there. Then the Qs bounced back up in an almost miraculous fashion, moved way back up to over $118. Please know that the all-time high in the Qs is $120.50 back in, I believe, the year 2000. Right now, and since the fall, since 2000, the bear markets, it's made its way all the way back up to just about within 2 or 3 points of that all-time high. So it's looking pretty good here. I want to see if the big, strong tech leaders can continue higher in coming weeks. The Qs were at $117.37 when I captured this chart. They have resistance right here. It has resistance right here at about 118. Can these big tech dudes stay muscular and resume the uptrend they've been in now that we've got more traders coming back in from summer vacations and we're getting past the Labor Day weekend here next week? Can they resume this uptrend? Can it move higher here and break higher, these big tech guys? Or are they going to find it necessary to get a little profit taking coming in here and move back down toward their 50-day moving average, which is coming in right now at a little under 114? So that remains to be seen. We do see, we'd kind of been warning here that the RSI was in a bearish divergence. It's starting up a little here on today's move up. The MACD line shows that the black line, the MACD line, is still below the signal line. That is a slight negative, although both lines are still above the zero line on this scale, and that, of course, is a positive. So we're kind of in a wait-and-see mode here. Certainly the Qs are in an uptrend, as is the S&P 500. We'll have to see what the coming weeks bring in the way of news, hopefully good news for all of these indexes. Now let's go on to one. There's 2 or 3 or 4 probably indexes that have been tromped on a little bit because it appears as though at some point here in the next few months the Fed will raise interest rates. One of the industry groups that's been a little beaten down here is the iShares U.S. Real Estate ETF. That's because it does pay such delicious high dividends, and of course when it looks as though the Fed will raise interest rates, people move into Treasury bonds because they are supposedly the safest vehicle in the world, and they move out of high-paying assets like REITs and telecom and utilities and staples. So right now we can see that in the past weeks here, the IYR, this is the iShares U.S. Real Estate ETF. We know that it made an August high of 85.89 right up here. It has made a recent low down here on this consolidation. One day it dipped down to $81.24. So we can say it has support here in this recent 2-week consolidation of about 81.25, 81.50. We can even tighten it up to 82 if we want. I'm looking at the IYR now that it appears, at least for the next couple of weeks, that a rate hike is not going to happen, and maybe not on September 21st. There are those who are going to say, hey, the Fed's not going to raise rates here. I'm getting back into my high dividend paying assets. And of course, REITs are one of those assets. We can see that when I captured the IYR here, it was trading at $83.15. This morning early it had popped up and above its 50-day moving average. The market sold off a little bit and the IYR moved back down to just barely under its 50-day moving average. It is trading at the moment above its 20-day moving average, the red line, and of course the 200-day moving average is down below, just a little under 77. The RSI here had dipped to about 40 and not quite oversold, but close to oversold condition. And actually I like this pattern where the RSI dips down and then hooks up around the 50 line. The MACD line is still below the signal line, as it would be with a pullback like this. I want to see if it'll pull back up over the 0 line. That would be a good thing, and actually a pretty good signal maybe for an entry here. So I'm going to watch the IYR in the coming week. I'm going to see if it can move back above the green line, the 50-day moving average. If it can, I'm not going to I may take some shares in the IYR and see, as long as it remains above the 50-day moving average. If it moves back down below that and back down below $81.25, at that point it will no longer be of interest to me, and if I have shares I will sell it. So I don't want it below this 81.24 line. Do not. But if it can maintain a little upward momentum here, potentially it could move back up to 84, 85, and even head back up toward 86. Now we'll go on to next week's economic reports. But first, please join us this coming this coming Tuesday. The market is closed for Labor Day on Monday, so please join us this coming Tuesday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, no problem. The recording of our session is available to all of our members just a couple of minutes after the session ends. And now for the coming week's economic reports. On Monday, of course, the market is closed for the Labor Day holiday. Tuesday, we have ISM services. Wednesday, we have the Fed's Beige Book. Thursday, we have jobless claims, natural gas inventories, and crude inventories. Crude inventories are delayed today because of the holiday. Friday, not much going on economic report-wise. Please remember to join us this coming Monday for Tony's Market Club. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is the Market Now.